Understanding Pretax Profit Margin, a comprehensive guide. What is a pretax profit margin? The pretax profit margin is a vital financial metric used to evaluate a company's operating efficiency. It reveals what portion of a company's revenues translates into profits before taxes are deducted, essentially answering the question of how much profit a business retains on every dollar of sales. This metric is particularly beneficial for comparing profitability among companies within the same industry, as tax rates differ across states and regions, potentially skewing bottom-line profitability. Key takeaways. Pretax profit margin is essential for assessing a company's operational efficiency. This metric emphasizes how effectively a business is converting sales into profit before tax implications. Unlike standard profit margins, the pretax profit margin eliminates the variability introduced by differing tax expenditures, making comparisons among competitors more straightforward. However, its utility diminishes when comparing firms across different sectors due to distinct operational expenses and revenue models inherent to each industry. Understanding pretax profit margin. Companies strive to maximize their profitability to satisfy investors and stakeholders. Profit margins, including the pretax profit margin, serve as a key indicator of corporate health. A consistently high pretax profit margin often reflects a well-managed company with effective cost control and pricing strategies, whereas a low margin may signal inefficiencies or challenges in the business model. Management teams focus on the delicate balance of boosting sales and minimizing costs to enhance profitability. Analysts and investors rigorously monitor pretax profit margins as part of their decision-making process, often presenting it prominently in financial statements. Variability in pretax profit margins. The pretax profit margin can vary significantly by sector. In industries with low operating costs or less competition, like legal services, a high pretax profit margin is typical. Conversely, sectors like airlines, characterized by high operational expenses, tighter profit margins, and fierce competition, will display lower pretax profit margins. How to calculate pretax profit margin? To calculate the pretax profit margin, only two pieces of data from the company's income statement are necessary: revenues and earnings before tax, EBT. The formula is as follows. Pretax profit margin equals EBT/revenues times 100. Example calculation. Consider Easy Supply, which reports gross profit, $100,000. Operating expenses, $50,000. Interest expenses, $10,000. Sales, $500,000. To compute EBT. 1. Subtract total expenses from gross profit. EBT equals gross profit, operating expenses plus interest expenses. EBT equals $100,000, $50,000 plus $10,000, equals $40,000. 2. Calculate the pretax profit margin. Pretax profit margin equals $40,000/$500,000, times 100 equals 8%. Pretax profit margin versus profit margin. While regular profit margins post-tax are often the focus for analysts, many argue that they do not provide a complete picture of operational efficiency. Tax liabilities can disproportionately affect net income figures, making it critical to look at pre-tax metrics for a truly operational perspective. Alternative metrics. An alternative measure like the Berry ratio, which compares gross profit to operating expenses, can also provide insights absent the complexities of tax expenditures. Limitations of the pre-tax profit margin. Despite its advantages, the pre-tax profit margin has limitations. Sector-specific limitations. A blatant limitation is that it can skew when used to compare companies from disparate industries, where operating expenses and revenue structures vary widely. Economic conditions. Economic downturns can also impact margins across various sectors. For instance, services in sectors like hospitality may exhibit lower margins during economic recessions. Because of these factors, Analysts typically recommend using the pre-tax profit margin in conjunction with other financial metrics for a more holistic view of a company's operational health. Evaluating pre-tax margins, good or bad? Is a higher or lower pre-tax profit margin better? Generally, a higher margin indicates better financial health and operational efficiency. However, consistency is paramount. An exceptional margin in one quarter does not establish a sustainable business. To provide context, a pre-tax profit margin of 7% might be commendable in certain high-overhead sectors, while it could indicate inefficiency in high-margin industries. Conclusion: the pre-tax profit margin serves as a crucial tool for investors and analysts seeking to gauge a company's profitability while circumventing the variability that tax expenditures can introduce. By evaluating how well a company converts its sales into earnings before tax implications, stakeholders can make more informed decisions. In a landscape where profitability is key, understanding, and accurately interpreting, the pre-tax profit margin is essential for investors keen on assessing the operational efficiency of potential investments. As always, this metric should be part of a broader financial analysis that includes other ratios and metrics for comprehensive insights into a company's financial health.